Welcome to the Two Beans in a Pod. Today we're tackling, well, arguably one of the most significant topics in global macroeconomics, the future stability of the US dollar. I mean, despite all the chatter and concern, it's still the anchor, right? Holding around 57% of global foreign exchange reserves, dominating trade invoicing. But yeah, the question of its longevity is everywhere.
It really is. And the core debate today, as we see it, isn't really if the dollar's dominance is being challenged. I think that seems pretty clear given geopolitical shifts, but how that change is likely to play out. So the question is, are we looking at a primary risk of a strategic, sort of slow, managed erosion of its global reserve status, something leading towards a multipolar currency world, what we're calling a long fade? Or is the bigger systemic risk actually a catastrophic, rapid collapse? Hyperinflation, loss of stability, driven mainly by domestic policy failures here in the US. Now, I'll be arguing that the evidence points more strongly towards that strategic, gradual erosion. The long fade toward a multipolar landscape seems the most probable path.
Okay, and I come at this from a slightly different angle. While I absolutely recognize the importance of those external challenges you mentioned, I worry that focusing too heavily on them kind of distracts from what I see as the dollar's fundamental and, frankly, catastrophic weakness. I'm going to argue that the US dollar is most vulnerable to a rapid, self-inflicted wound, a catastrophic loss of stability driven primarily by internal fiscal dysfunction, potentially leading to those hyperinflationary outcomes we've unfortunately seen historically.
Right. I see why you think that, especially rooted in those terrifying historical precedents. But let me offer a perspective grounded more in the current structural dynamics. I think the decline we're seeing is an erosion, precisely because geopolitical forces are sort of forcing a managed transition, not an abrupt collapse. Look, countries are actively responding to what they perceive as the geopolitical weaponization of the dollar. Think about the extensive use of financial sanctions against major economies like Iran, like Russia. That's directly spurred the development of parallel financial infrastructures.
China's CIPS, their cross-border interbank payment system, or Russia's SPFS. These are designed specifically to bypass the dollar-centric SWIFT network. And these aren't just theoretical anymore, they are operational alternatives. And central banks themselves are confirming this by actively diversifying their reserves. We've seen a meaningful, steady decline in the dollar's share of global reserves just over the past 2 decades, and that coincides with central banks making record gold purchases. That's a pretty clear shift towards a non-aligned, tangible reserve asset. So the logical outcome here, I think, is a future multipolar currency landscape. The dollar probably retains strength regionally, maybe in the Americas because of trade ties and inertia, but it shares global dominance with the euro in Europe and potentially the yuan playing a much bigger role in Asia. So its supremacy is fading, yes, but it's not being detonated overnight.
Okay, that's a compelling case regarding the speed and nature of external pressure, but I'd frame it differently. I think those alternatives you mentioned, CIPS, SPFS, gold buying, they merely provide a convenient destination for capital that might already be fleeing a system, potentially losing confidence. The real acute danger, as I see it, is self-inflicted damage, causing a catastrophic loss of value. That leads to the kind of instability that defines true hyperinflationary crises. I mean, the dollar's fundamental weakness is that its value is purely based on government fiat. It completely lacks the discipline that, say, a commodity-based standard like the gold standard once enforced, for better or worse.
Right.
So if confidence is lost, really lost in the Federal Reserve or in the U.S. government's ability to manage its, frankly, ballooning debts, the dollar itself becomes unstable, unpredictable. You cite geopolitical strategy. I'm citing the historical blueprints for collapse. Look at the Weimar Republic, 1923. One U.S. dollar was worth 4.2 trillion marks. Or Zimbabwe more recently, where money creation financed massive fiscal deficits. The mechanism is tragically similar. When governments feel forced to print money just to pay their bills, the currency can become worthless almost instantly. That kind of instability is rapid, it's total, and it far outpaces any sort of strategic diversification efforts by other countries.
Okay, let's push on that comparison though, because I think that's really where our views diverge most sharply. External strategic shift versus domestic fiscal self-destruction. I still maintain the dominant shift is external and strategic. It's driven by foreign central banks who've basically decided they need decentralized alternatives. Take the global dollar or GD proposal. It's not just academic theory. It's being designed precisely because central banks want an alternative that mitigates the global contagion risk that comes from any single country's monetary policy mismanagement. Yes, they might fear U.S. instability, but their demand is for systemic diversification, almost regardless of whether the U.S. fixes its budget tomorrow. It's this inherent institutional demand for a globally decentralized safe haven asset, one not tied to any single nation's fiscal whims, that's driving the managed diversification we're seeing.
Plus, the sheer scale, the institutional depth of U.S. financial markets, that provides an almost insurmountable barrier to the kind of rapid flight you're describing. I mean, the U.S. today is not post-World War Germany.
But I'd argue foreign strategy is largely responsive. Fiscal indiscipline is causative. While sure, the GD model might be an aspiration for stability down the road, the true volatile engine of currency collapse is uncontrolled fiscal failure at home. You just can't diversify your way out of a printing press that's being run flat out domestically to fund government spending. High inflation kicks off the Oliveira-Tanzi effect. It's this devastating feedback loop where the real value of tax revenue just evaporates between when the tax is assessed and when the government actually collects it.
Right, the lag effect.
Exactly, and that forces the government to cover widening deficits by, well, printing currency, what economists often call the inflation tax. When a government loses its ability to fund itself through traditional taxes or borrowing at reasonable rates, this internal fiscal pressure inevitably leads towards hyperinflation if trust breaks. It doesn't really matter if China has SIPs ready or not. I mean, the collapse of the Zimbabwean dollar was a direct result of the government choosing money supply manipulation as basically the only tool left to fund expenditures, not because the South African rand suddenly became more attractive to international reserve managers.
Okay, that brings us, I think, directly to the consequences. Let's assume my scenario for a moment, the slow fade, the multipolar world. If that's correct, how does that more, let's say, manageable transition actually affect the U.S. economy? And maybe more importantly for our listeners, the average person or investor.
Yeah, what does that look like?
Well, I argue a slow fade is manageable precisely because it's a transition likely over decades, not months. What it means is the U.S. gradually loses some of that exorbitant privilege. You know, that hidden massive subsidy we effectively get because the world needs to hold U.S. dollars for reserves and trade. When we lose that, yes, borrowing costs for the U.S. Treasury will inevitably rise. And while that definitely threatens federal and state budgets significantly, the sheer depth, the liquidity, the established network of U.S. capital markets, they provide a huge cushion compared to smaller economies facing similar pressures. So for the average listener, this scenario probably means, greater currency volatility, maybe a need for more careful portfolio diversification, but mass societal breakdown isn't the immediate likely concern. The government might have to make gradual, perhaps painful cuts to discretionary spending or infrastructure projects over time, but the system itself holds together.
See, I'm sorry, but I just don't quite buy that managed transition if the internal fiscal situation is what actually triggers the downfall. If the world truly loses confidence because of self-inflicted damage, the effect of a rapid collapse would be, well, devastating domestically and immediately noticeable. Losing reserve status, especially quickly, means significantly higher borrowing costs for the U.S. government, potentially almost overnight. And think about the scale. The U.S. government is currently running a deficit of, roughly $1.8 trillion? That's about 26% of the total budget.
Yeah, it's substantial.
It's huge. So much higher borrowing costs translate into exponentially higher interest payments on the national debt. This would force massive, wrenching reductions in federal and state spending almost immediately. For the average person, this translates directly into severe, immediate cuts to things they rely on. Public services, maybe Medicare funding, perhaps even military spending, alongside potentially a liquidity crisis, where the currency's purchasing power just deteriorates so rapidly that cash savings become nearly worthless very quickly. It's really the difference between, say, gradual belt tightening and a sudden systemic breakdown of economic trust.
You raise a very valid concern about the fiscal trajectory, no doubt, but I might frame the domestic policy failures more as powerful accelerants to an underlying long-term geopolitical trend, rather than the singular cause of a global currency collapse. The external forces, I think, dictate the general direction of travel. Domestic mismanagement dictates the speed, maybe the bumpiness of the journey.
An accelerant. Okay.
Look, this whole discussion on the fundamental risks wrapped up in national debt and currency confidence, it should really remind all of us about the value of this kind of rigorous analysis when we're assessing economic stability.
Absolutely.
And if you appreciate exploring these complex, sometimes pretty high-stakes economic scenarios with us, please do remember to hit that like button and subscribe. It really helps ensure you don't miss our future intellectual exchanges.
Definitely. So, okay, let's turn to protection strategies then, because this is where the nature of the potential collapse really dictates the right defensive action for investors, doesn't it? In your slow fade scenario, the managed transition, what does protection look like for someone with a diversified portfolio?
Right. In a slow fade, multipolar world, investors need to strategically hedge against, let's say, diminishing USD, but they likely have some time to adjust. So this could mean implementing dynamic currency hedging strategies. It might mean tilting global equity exposure away from, say, US megacaps towards potentially higher growth international markets. And following the central bank's own lead, maybe increasing allocations to gold as that non-aligned liquid reserve asset. Also, assets like US and international stocks can be a strong defense because, good companies can often grow earnings by raising prices in inflationary environments. And we can also use things like Treasury inflation-protected securities, TIPS. These are bonds specifically designed to offer inflation protection in the fixed income part of a portfolio because their principal value adjusts based on the consumer price index.
Okay, but TIPS and conventional currency hedges, look, they're designed for predictable, gradual inflation, maybe single-digit, maybe low double-digit annual rates. They are, I would argue, entirely inadequate for the sudden catastrophic scenario that I'm projecting might be the bigger risk. I mean, when you're potentially facing annual inflation rates equivalent to, 12,000% plus, like we saw historically in these high crisis environments, protection requires a rapid, almost immediate flight from currency itself into hard assets.
A lesson from history from Weimar Germany to Zimbabwe is that currency can become worthless almost as soon as it's printed in those extreme situations. So protection demands holding assets that retain real value. This means moving into tangible, physical, hard assets, things like real estate, critical industrial commodities, and yes, precious metals, maybe beyond just gold, silver too. Those assets might be volatile themselves, sure, but they offer some protection against the kind of catastrophic loss of purchasing power that renders currency-denominated assets, including maybe even TIPS, in extreme cases, almost useless overnight.
Okay, so our disagreement here really boils down to, fundamentally, one of probability and tempo, doesn't it? My analysis, which is rooted more in institutional and structural shifts globally, suggests the most likely path is this strategic rebalancing. The dollar's lead is diminished, sure, but not destroyed. We move toward a multipolar strategic reserve framework. And preparation for that involves, yes, sophisticated portfolio diversification and hedging over time.
And mine suggests that while, yes, foreign alternatives certainly exist, they might just be symptoms or destinations. The greatest and potentially most volatile threat is that rapid, self-inflicted wound of losing domestic confidence in the fiat currency system itself. That could trigger hyperinflationary forces that demand immediate protection through tangible, real-value assets that require, frankly, liquidity and accessibility more than sophistication.
Right. But I think both perspectives confirm one crucial thing for any intelligent investor listening. The unchallenged stability of the US dollar is certainly no longer guaranteed. Active preparation for a world less reliant on its dominance is, well, it's essential.
Absolutely. You need to weigh the evidence for both scenarios and plan accordingly.
Well said. Thank you for listening to this intellectual exchange on the future of the dollar. We really encourage you to continue exploring these complex economic scenarios.
And if you value this kind of rigorous analysis, please do subscribe and maybe leave a review. It helps others find the discussion.
Thank you for listening to Two Beans in a Pod.